So for those folks that maybe were listening a little bit to the media this past week, you might have heard them talk about the VIX. What that stands for is it is the Chicago Board Options Exchange Volatility Index, also kind of known as the Fear Index, if you will. And what it measures is sort of the market's expectations for the relative strength of kind of what the near-term price changes are going to be in the S&P 500. The VIX can be traded using options, ETFs, things like that. It is ultimately calculated on a on a regular basis. I mean, every second of the market, it's getting calculated to sort of produce a measure of the 30-day, forward expected volatility of the U.S. market derived from kind of the pricing of the different companies in the S&P 500 in terms of index calls and puts and so things like that. So obviously it's got a convoluted formula. It's not just looking at kind of the S&P companies, but it's really looking more at that call and put types of strategies that are going on. So it's a complicated formula. Of course, it has an index relationship, right?
Sure.
So if the VIX is high.
Right. It's really the easiest way to think about it is it's a measure of price action, I suppose would be a good way to say it. The quicker and more violent the swings of prices of different things, one way or another, good or bad, up or down, the VIX will go up, and if the market is trading more flat, then it will go down. It's more of just a measure of how violently prices of different assets are flipping around.